Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
Hello, everyone, and welcome to the CanBridge Evercore Fund monthly update for December 2025. I'm Derek Lee, portfolio and investment fund analyst at Corton Capital, and I'm excited to walk you through our performance, market outlook, positioning as we close out 2025 and look ahead to 2026. Let me start with the headline numbers. December was a positive month for the fund, and I'm pleased to report that as we finish 2025 with a 4% return for the first 11 months of the year. That brings our total cumulative return since inception to 7.45%. We are in the process of finalizing the December 2025 return and expect it to be slightly up. What's particularly encouraging about this performance is that we achieve it while maintaining our focus on generating stable income through cash-generating underlying assets and strategies. The fund also showed great resilience during the broader market downturn after the Liberation Day tariff announcement by Mr. Donald Trump. Now, let's dive into what's happening in the broader market, because understanding macro environment is critical to understanding how we are positioning our portfolio. We will start with interest rates. The Bank of Canada held steady at 2.25% in December, which is, I think, is neutral to positive for real estate valuations across our portfolio. Meanwhile, the Fed in the US maintained its rate in the 3.5 to 3.75% range, which continues to support the yields we are seeing in our private credit investments. These stable rate environments are really what we want to see after the volatility of last few years. On inflation, Canadian CPI came in at 2.4% year-over-year with a slight uptick. Now, some investors might worry about inflation, but for our portfolio, this is actually fairly neutral to positive. Inflation is contained enough that's not forcing emergency rate hikes, and there is some inflation support gradual rate increases in our real estate holdings over medium term. That's the top 3 macro highlights, and for the bottom part, we will dive into the details for sector-specific highlights with our portfolio exposure. For Canadian multifamily residential real estate, one metric I'm watching very closely is apartment vacancy rates. We are seeing them rise in the near term as new purpose-built supply hits the market. Property owners are increasingly prioritizing occupancy over rent growth right now, which is creating some near-term pressure. And this is important, the longer-term outlook for rental housing remains extremely positive because Canada still has a massive structural undersupply of housing. So while we might see some short-term NAV adjustments on valuation in our apartment-focused REITs, the fundamental thesis remain intact. On the industrial real estate side, we are seeing stabilizing after a period of oversupply. The Canadian industrial market vacancy rate settled at 5.5% in Q4 2025. And here's what's really encouraging. net absorption gained significant momentum in the latter half of the year. We saw 7.9 million square feet absorbed over the final 2 quarters, which is complete reversal from the negative 11 million square foot we saw in the first half of the year. This tells me that the market is digesting new supply, and we should see modest near-term rent pressure ease as we move through 2026. Let me talk about infrastructure for a moment, because this is one of the most exciting area we are invested in the moment. The infrastructure environment heading into 2026 is particularly favorable. Deal making is up 22% year-over-year, driven heavily by renewables and digital infrastructure demand. And when I say digital infrastructure, I'm really talking about the AI revolution and what it means for power demand. The surge in AI development is creating massive demand for data centers, energy infrastructure, and transmission capabilities. Companies like Microsoft, Google, and Meta are making enormous investments in AI infrastructure, and that requires power. Lots of it. It's definitely an exciting time for infrastructure investing. Now, let's talk about private equity, which has been through a challenging period, but is showing real signs of recovery. After 2 years of subdued activity, private equity is beginning to regain its footing. Easing interest rates are restoring confidence, narrowing valuation gaps between buyer and sellers, and supporting a gradual return of liquidity to the market. In the first half of 2025, US private equity deals value rose roughly 8% year-over-year to just over 195 billion. More importantly, we are seeing an improving exit environment. Private equity funds need to be able to exit the investments to return capital to their investors. And for a while, that market was essentially frozen. Now we are seeing IPO windows open up again, more strategic M&A activity, and more sponsor-to-sponsor deals. This improving exit environment bodes very well for our private equity allocation through the BMO Carlyle LP Invest PE fund. Let me now break down our December performance attribution, because I think it's instructive to see what worked and what are facing headwinds. Our top contributors in December were solid across the board. The BMO Carlyle Private Equity Strategies Fund delivered 80 bips for Canada hedge version and 90 bips for the USD version. The KKR Infrastructure Fund contributed 57 bips for the Canadian hedge allocation, and our Astra Structural Credit investment performed particularly well, with December 2025 series up 2.55% and the June 2025 series up 2.06%. And CanFirst Income Plus Real Estate Fund contributed a nice 2% return for the month. On the other side, Centurion Apartment REIT saw its NAV adjusted down approximately 4.87%. This was directly related to those near-term pressure I mentioned earlier in the multifamily apartment space. Rising interest vacancy rate and slowing rent growth as new supply hits the market. However, overall, our diversification strategy worked very well and exactly as intended. The positive contributions from our broader holdings more than offset the negative impact from Centurion, leaving us a small overall gain for the month. This is a perfect example of why diversification matters so much in alternative investments. No single holding dominates the portfolio, and strength in one area can offset weakness in another. So let me walk you through our current portfolio positioning, because we have made some strategic adjustment recently. You can see on the left side, we have built a very diverse portfolio where each position generally takes a 4 to 8% allocation. Looking at our sector allocation on the right, We currently have about 32% in real estate, 27% in private credit, 17% in infrastructure, and 12% in private equity and venture capital, 4% in hedge funds, and about 6.2% in cash. This allocation reflects our view that we want a defensive income-generating alternative asset while maintaining exposure to some growth opportunities. We are actively looking to deploy in one or two new names with the cash on hand. Now let's discuss the recent material changes we have made to our portfolio. I think these additions really reflect where we see opportunities going forward. First, we initiated an allocation to the AQR Apex strategy with a Canadian hedge. AQR Apex is a multi-strategy hedge fund with particular strength in combining factor and value investing. With volatility expected to remain elevated in the coming quarters, we are certainly going to see that with ongoing trade policy uncertainty and geopolitical tensions. We believe this fund can take advantage of the higher volatility environment while still benefiting from the public market trending higher over longer term. This currently represents about 4% of the portfolio. Secondly, we initiated an allocation to the EQT Global Infrastructure Fund. This is really exciting because EQT is one of the premier global infrastructure investors, and this fund provides access to pure private infrastructure opportunities. We're talking about essential assets that power economies, things like renewable energy projects, digital infrastructure, transportation assets. The fund focuses on value-add infrastructure opportunities and aims to provide private equity-like returns with stability characteristics of infrastructure investments. It's a perfect complement to our KKI infrastructure holding because this gives us broader geographic and sector diversification. On the reduction side, we trim our exposure to Blue Owl Private Credit Fund. This wasn't a concern about private credit quality. Blue Owl is a very good manager, but more about portfolio rebalance due to expected rate cuts in the US, as these loans are floating rates and will have a lower yield with rate cuts. In general, we expect 2 rate cuts in the 2026 from the US Fed. We also reduce our Centurion apartment risk position given those near-term headwinds we have discussed in the multifamily space. Now let's talk about where we go from here and what's our outlook for the first half of 2026. I think the dominant macro catalyst that everyone needs to be watching is the CUSMA review scheduled for July 2026. CUSMA is the Canada-US-Mexico trade agreement, and this review will heavily influence Canadian economic sentiment and business investment decisions. There's elevated uncertainty around trade policy right now, and that creates some caution in the market. But here is our overall assessment. First half of 2026 represents a constructive but cautious environment. Our portfolio is well diversified across defensive alternative asset classes that should benefit from several positive structural trends. First, the real estate cycle is turning positive as new supply gets absorbed and structural undersupply will assert itself. Second, infrastructure demand continues to be driven by AI development and the energy transition. Third, private credit continues to provide stable income even as spreads compress somewhat. And fourth, private equity exit market are recovering, which should support valuation in our PE holdings. Looking at specific opportunities, we are actively looking to participate in the US industrial real estate space to take advantage of the onshoring trend. Morgan Stanley Net REIT is a potential candidate that we are evaluating. The dynamics in US industrial are quite positive. Companies are bringing manufacturing back to North America, nearshoring supply chains to reduce dependency on Asia, and all of that requires warehouse and distribution space. this is a multi-year trend that we want exposure to. But overall, we are not looking to make dramatic portfolio changes. We continue to monitor the market closely, but we expect the Evercore Fund to continue delivering steady performance through 2026. The portfolio construction we have, combining real estate, infrastructure, private credit, private equity, and now a hedge fund allocation, gives us resilience across different market scenarios. I'm excited about the opportunities we see as we move into 2026. The portfolio is well positioned. Our underlying managers are among the best in the business, and we maintain the discipline to make strategic adjustment when we see opportunities. If you are interested in hearing more about the investment opportunity, please email to info@cortoncapital.ca and a dealing representative will reach out to you. Thank you for your trust and confidence in the CanBridge Evercore Fund. Our next update will be in March 2026. If you have questions, please don't hesitate to reach out to us at Corton Capital or visit our website at cortoncapital.ca. Until next time, this is Derek. Thanks for listening.